Okay, hello everybody, and welcome to Investing with IBD, sponsored by MarketSmith. Today is November 18th, 2020. I'm your host, Arusha Pierce, and today we have Kenny Polcari on the show. Kenny is a managing partner of Kace Capital Advisors and chief market strategist at Slate Stone Wealth. Thanks for being here, Kenny.
Thanks, Arusha, for having me. It's always a pleasure. I feel like I'm coming home after all those 6 years at O'Neill Securities.
That's right. Welcome home, man. On today's podcast, we are going to talk about the current markets. We're going to talk about the concept of remaining open-minded and not sticking your head in the ground. And we will end the episode with a few current ideas. Let's get right into the current market. The current market is in a confirmed uptrend. We have 2 distribution days on the NASDAQ, 1 on the S&P 500. Kenny, what are your thoughts on this market right now?
Well, I love the fact that you say we're in a confirmed uptrend, considering today the market ended up selling off 350 points and it picked up speed as we moved into the end of the day. I do think you're right, though. I do think the broader market over time is in an uptrend, but in the short term, and I tend to, because of my history, I tend to think day to day because of where I worked and spent the bulk of my life, is that I do think that we're in for some short-term volatility. And I think today was just a perfect example of another day where we hit some kind of an air pocket and a void in the bid side of the market, and we saw what happened. Right, as because nothing's really changed between yesterday when the market rallied and today when the market sold off. The only thing that changed today is that New York City announced that they're closing their school system starting tomorrow, and all of a sudden everybody in the country starts selling stocks, which makes no sense at all. But that's the headline, by the way. But that's the headline on Bloomberg today, is that they credited the sell-off to the fact that de Blasio came out and said no one going to school anymore. And I thought to myself, geez, why would people sell Johnson & Johnson and Coke and Intel and Microsoft because New York City kids are staying home from school? That doesn't make a lot of sense. But what does make a lot of sense is that the market is still very anxious, right? There's still a lot of anxiety out there, still a lot of uncertainty out there. Stocks have gotten well ahead of themselves. Nobody really expected the surge that we saw after the election. And the fact that the election is still not really settled, and I don't necessarily mean the president, because I think that is settled, but what isn't settled is the Senate. And so we're not going to know until January 6th now what happens in the Senate. And so a lot hinges on that election, because it could change the face of the whole executive branch for at least the next 2 years until the next midterm cycle elections, right? So, and so therefore, I think the market's gonna hit these pockets of uncertainty and cause days like you saw today. I'd actually like to see another one of these days. I'd like to see the market back off a little bit and be able to buy some cheaper stock.
Now, so first talk about, because you are looking at a shorter term time frame, but are you also balancing it with a longer term, or you just mainly focus on what you've been doing for years and years on the shorter term basis?
No, I've actually made the pivot. I do now, in my current role as managing partner of Kace Capital and as a chief market strategist at a $1 billion plus wealth management firm, is I have to have more of a long-term role. It's great to talk about what's happening in the short term, but investors don't invest for the short term. They invest for the long term, right? A trader trades in the short term. A trader doesn't even invest in the short term. He trades in the short term. But an investor, just the term alone suggests that it's a longer time period, right? And so today, yes, I've made that pivot from those days, those 40 years that I spent on the floor of the New York Stock Exchange representing institutions at the point of sale at that very moment in time to buy or sell stock. And so I was very keen to feeling and understanding and responding to what was happening at this moment in time. And if the stock was under pressure, why it was under pressure, what I needed to do to represent that client appropriately at that time.
Yeah. And so how has been that pivot? Because I know for myself, going too short term kind of time frame, I'm just not good at that. And I learned the hard way that, okay, that's not my thing. More of the intermediate and being super long term isn't necessarily for me. So I find kind of the sweet spot for myself being more the intermediate can slim type of strategy. How are you finding that pivot, trying to extend that time frame?
So I listen. I'm okay with the pivot, right?
Yeah.
Because part of me is I lean back on my own personal view and investing experience. Because even though I spent all those years on the exchange and that was very much in and out, my
Yep.
personal portfolio, the money that I put away for the long term, as an investment to accumulate wealth, was always very long term
Okay, that
focused,
makes
right?
sense. Yep.
I wasn't. I was never the short-term type of trader. First of all, it was too difficult to be a short-term trader when you worked on the floor of the exchange because you were so busy representing institutions at the point of sale that you couldn't do that and concentrate
That
and
makes
try
a
to
lot
be.
of sense. Yeah.
And number one, you couldn't do it. Number two, you couldn't do it from the floor of the exchange. You'd have to, if you wanted to buy or sell something. When I worked on the floor, I'd have to leave the floor, go outside, be outside of the building. I'd have to, if I wanted to buy or sell a stock, I had to make sure that I wasn't in that stock that day. I had to make sure no one in my firm was in that stock that day. So there was so many restrictions, it became too onerous. And so I
Yep.
never really did it. Right. My
That
money
makes a
was
lot of
always
sense.
long-term. And so it's fine. So I was able to make that pivot
Yep.
with not too much difficulty, but I still very much like to talk also the short term because I love to talk about the markets. Right. And I do
Oh
that
yeah.
every day in that daily blog that I write.
Yeah. And so let's take a step back and how'd you get into this? Because yeah, you've been on TV for many years, and it's always great to watch, and you're full of knowledge and experience. How did you end up in the place that you're at?
Oh my God. How much time do we have?
We'll extend it. The
Yeah.
podcast.
Yeah. So listen, you got to understand something. I was a kid from Boston, right? I didn't grow up in this. Um, I didn't know what the New York Stock Exchange was. I didn't know a stock from a bond, a buy from a sell, an eight from a quarter. I knew nothing. When I graduated high school and went to college, I went to school in Washington, D.C., because I thought I wanted to be a politician and then the president of the United States. And thank God I'm not the president of the United States. I don't know why anybody wants that job, but one way or the other. And when I was a freshman in college, I had the opportunity to go spend a summer in the New York Stock Exchange. And I had never been to New York. And I was a kid, like I said, I grew up in Boston. I spent my summers on Cape Cod. I was now 19 years old, just after my freshman year. And I had these visions of going back and putting on a bathing suit and being a lifeguard on the beach in Cape Cod. I mean,
This is before Baywatch too, right?
But right before Baywatch, right? But does it get any better than that at 19 years old? And so
Yeah,
when I had this I had this opportunity to go move to New York City and go work on the floor of the exchange. Who the hell would want to do that? Because why would I want to be in New York City of all places? Why would I want to be in the city in the summertime? Why would I have to wear a suit and a tie in the summertime, right? When I wanted that. And so my first reaction was no. And when I went back to college in the second semester of freshman year, I started talking to people and what were other kids at school doing for the summer. And, a lot of kids were going out to get a real job, right? And I thought to myself, oh, shit, maybe I should reconsider this.
Yeah.
So I reconsidered and I thought to myself, okay, there's going to be two outcomes here, right? I'm going to go there and I'm either going to love it or hate it. And if I hate it, that's fine. I'll do it. I'll put it on my resume. It'll be great. And I'll move on. And if I love it, who knows? It could change the course of my life. Well, if you haven't figured it out by now, I absolutely fell in love with it, and it completely changed the course of my life. Is that I went back to college in September of my sophomore year. I transferred out of school in DC, and I transferred back to Boston University. I went to the School of Management because now I wanted to study business. I wanted to go back and work on the exchange. Now, listen. Here's the deal. I was 19 years old and I stepped on the floor of the New York Stock Exchange. And if you've never been, for those people that are listening to this podcast who have never been, I can only say you missed the greatest place that existed. It was this phenomenal place that had 5,500 type A personalities running around, screaming and yelling, speaking in a foreign language meaning they were speaking in the language of the market, right?
Yep.
The way they represent themselves as a buyer or a seller, or how they represent themselves in an active crowd versus an inactive crowd. Days when there was news out, days when there was no news out. It was full of these very colorful personalities, right? Now, listen, my generation, and I'm now 60, but I was when I went there, it was 1980. My generation was the first generation that had any real formal education right beyond high school. Okay. Most of everyone that was older than me were people that had gotten picked up off the streets. Like, they were kids that grew up in Brooklyn and Queens and Staten Island and Manhattan. Yeah. They were Irish, they were Jewish, they were black, they were white, they were everything, right? It was a mixture of everybody.
Yeah.
But it was the one thing that everybody shared was everybody was a type A personality. And if you know anything about type A personalities, they feed on each other, right? It's the most amazing thing to watch. If you were type B, you got run over because, because it was just not your style. Anyway, so I stepped onto the floor in May of 1980. And I remember just being in awe of the place. And even though I had no idea what was going on because I couldn't understand what was being said and how they were talking in symbols and fractions. And, but there was just something about it that was so exhilarating that I couldn't even stand it. Right. I couldn't, like the bell rang at 4 o'clock and I ran home to go to bed so I could get up the next morning just to go to work because it was so amazing. Cool. Right. Yeah. And so I was there for about 3 or 4 weeks and all of a sudden I just go, this is it. Like it changed my whole mindset changed immediately. And so I spent that summer being, a gopher, and I read a lot of newspapers. I asked a lot of questions. I wrote a lot of reports. I delivered buy and sell tickets, all the stuff that you would do when you don't know anything, right?
Yep.
So I went back to school, and then at the end of sophomore year, I went back again to work for that same broker. I spent the next summer. I was a little bit more educated. I understood. I could interact. I could react. I went back to school into my junior year. And now I don't know what the demographic is on this podcast, but here's the deal. If what you have to understand was happening in 1980, 81 and 82, the country had just come out of the Jimmy Carter years. We had just come out of the oil embargo, the Iranian hostage crisis. The economy was in a complete disaster. And Ronald Reagan became president in 1980. The economy was still spinning out of control from the Carter years. Reagan had just, by 81 and 82, Reagan had passed this massive Reagan tax reform package, very much like what happened in the first 2 years of the Trump administration, right? Where they passed this massive tax plan. But the other thing that was happening was interest rates had skyrocketed. Interest rates were 21%. Inflation was running at 10%. Unemployment was running at 13%. It was a disaster. And there was no gig economy. There was no internet. There was no LinkedIn, Facebook, Twitter, or any other stuff. And so therefore it was a disaster. And guys that were my age then were getting thrown out of the business because naturally we were the older guys and the pay scale was higher and people losing money. And so how do you do it? You create efficiencies. You let go of the most expensive guys and and the kids getting out of college couldn't get a job. That's how bad it was. And think about this for a minute. If you were anybody in 1980 or 81 or 82 that had any money at all, and your choices were, you could take your money and walk into the bank and give your money to a banker who's going to put it in a CD, and you're going to earn 21% guaranteed sleep at night, no risk.
Oh my God, that's so ridiculous.
Or you're going to take your money and you're going to go to a brokerage house and you're going to buy Johnson & Johnson and American Telephone and General Electric, which are all fine U.S. companies. Except what are they? They're full of risk. And when the economy's in when the economy's in a bad place, and listen, again, 1980, although the world was connected, it wasn't connected the way it's connected today. Today, something happens in China and we know about it in 3 minutes.
Right.
Then you found out the next day when you picked up the newspaper.
Yes.
Right. And so it was an amazing time to be there. It was an amazing time to be alive, but it was also a difficult economic time in the country, right? And so I went back in the summer of 1982. It was now my third summer there. And I went back to go work for the original broker that I had been working for. He was an independent broker. He did a very traditional broker-dealer business. But remember what I said. A traditional broker-dealer business was they were suffering. Why? Because interest rates were 21% and people weren't buying stocks. They were going to the bank.
Yeah.
And so this poor guy, when I came back in May of 1982, he put his arm around me and basically said to me, I can't have you. Like, I can't listen. And I was making $125 a week.
Yeah.
And it was just $125 that this guy, it was just another expense that he couldn't accept. Right.
Yeah. Yeah.
So I thought to myself, wow, I go, okay, maybe this is the summer I go back and be a lifeguard on the beach. But then I thought, I was down here for 3 years. I knew a fair amount of people. And so I said, let me walk around and go talk to some people and just see what's going on, feel it out. I don't know, who knows? So I walked around the main room and I ran into this other broker who I knew, probably in his mid-40s. He was a really dynamic guy. I love this man. He's the salt of the earth. He just turned 80 the other day on Halloween. And he's just, I just love this guy. But he had a different business. His business was option layoff business, and the options market in the early 80s was just taking off in Chicago. All these guys were trading these things called options, and every time they traded an option, they needed to hedge it with a stock transaction.
Perfect.
And so it was this option layoff business. And so this broker, unlike the other broker, his business was very much his option layoff business. So his phones didn't stop friggin' ringing because the options guys were all of a sudden very busy, right?
Yeah.
And so he puts his arm around me and welcomes me back. Oh, it's so nice to see you, blah, blah, blah. I said to him, Mr. Latham, I said, I just came to say goodbye because I'm not really staying because Doug can't have me. Doug's business is not doing well and Doug can't afford. And he looked at me, he goes, what are you talking about? I go, Doug can't have me. So he said to me, let me ask you a question, kid. He goes, you know the symbol for IBM? I go, yes, sir, it's IBM. He goes, you know the difference between a buy and a sell? I go, yes, sir. He goes, you know the difference between an eighth and a quarter? I go, yes, sir. He goes, how's $250 a week? $250? I just got a friggin' raise. Are you kidding me? My eyes went like this. It was unbelievable. I go, when do you want me to start? Right now. I started right now. It was unbelievable. Anyway, so I spent the summer of 1982 working for him. Now, remember what I said to you. The Dow was trading at 792. 792. Tonight it closed at 29,438. The average daily volume was 30 million shares on the day.
Unbelievable.
Today we traded, 6.9 billion. We do 30 million shares in about a minute and a half today. Because then we did it all pen and paper.
Yeah.
Right? Today it's done with computers. And interest rates were 21%, right? And unemployment was 13%, and inflation was 10%, and it was really a disaster. The country was in a disaster. And so it was a tough time, and it was a tough time. I was there in August. It was Tuesday, August 17th, 1982. And I remember it like it was yesterday. And here's the deal. On the Monday, there was a rumor floating around that the Fed was going to come out and make this surprise announcement on Tuesday. Now, right away, everybody starts to question it because, number one, the Fed never made surprise announcements.
Right.
The Fed would come out on Thursday mornings at 8:30. They'd open the door. They'd step out to a podium. They'd make a statement. They'd close the book. They'd turn around. They'd walk out the door and they'd shut the door. They didn't sit there all day and say, are you okay? Do you need a Xanax? Let's talk about this. Come sit on the couch. Tell daddy how you feel. None of that bullshit. They came out, they said what it was, and it was up to the market to figure it out, right?
Yeah. Yep.
So
Kenny, let's take a quick break here. We'll take a quick break, but when we come back, we are going to talk about August 17th, 1982, and what the Fed announced there and how they really started something pretty special for the stock market. Stay tuned. I am here with Scott St. Clair. Scott's one of our senior product coaches at MarketSmith. Now, Scott, there are a ton of publicly traded stocks just on the U.S. I think it's over 5,000 stocks. Who has the time to go through all of these stocks and find the very best ones?
Yeah, most people don't, right? So what you need is a tool like MarketSmith. We have decades of research on what makes a great winning stock. So we've done all the research for you. So we're going to try to highlight those specific stocks with those great data points. So if you're looking for that next great potential big winner, orange stock ideas button, you just click on it and you've got some of the main reports that we use, including the Growth 250.
Yeah, and the Growth 250 is the first list that I go through on the weekends.
Yeah, it's the most popular one, but there are others. There's the Breaking Out Today, Stocks Near a Pivot, and then the Blue Dot list, right, which is very popular. It's going to show you the stocks with the best relative strength. So we've done a lot of the work for you. What you have to do is review these lists. You're going to come up with some of the best ideas in that current market environment.
Perfect. Mark Smith saves you time and makes investment research that much easier. For more information, go to investors.com/podcast2020.
Kenny Polcari is our guest on Investing with IBD, sponsored by MarketSmith. Okay, Kenny, let's get back into your background and your story here. Let's get back into one of the most significant days for the stocks, and that's August 17th, 1982. So continue the story.
So now on the Monday afternoon, this rumor was starting to circulate the floor. Now remember, there was no internet, right? So no LinkedIn, no Twitter, none of that. So there was no communication that way. And since there was no television or radio on the floor of the New York Stock Exchange, the only way anyone on the floor got any information about what was happening in the world was when the phone rang and somebody from outside, meaning on a trading desk, First Boston, Goldman Sachs, a regional broker, whatever, called you up to tell you this happened or that happened, or right. And so the word started to come down from the different brokerage houses, that the Fed was going to come out. There's going to be this surprise announcement on Tuesday and blah, blah. And so everybody laughed because the Fed never did that, right? And so we all went home that night, and the market may have moved. The Dow might have been up 25 cents or down 37.5 cents. That was like a typical move in the market. Maybe It was up 75 cents, right? And so we went home on Monday night. We traded 30 million shares a day. The Dow was at 792. Not a big deal. So Tuesday morning, we all come to work. Now, listen, the market opened at 8:30. So the floor would start to fill up with people like 7:30-ish, 7:45, 8:15. People would get to work. They'd go to their booth spaces. They'd get the day started. They'd organize their tickets from the day before. They'd sit around and have coffee, read the paper, kind of shoot the breeze with the other brokers as you prepared for the day.
Mm-hmm.
So on that Tuesday, as 8:30 approached, you could almost feel the floor kind of get, everyone's kind of curious. Okay, it's going to be 8:30. It's Tuesday. There's supposed to be this rumor, this issue, this announcement, but we weren't going to know until the phone rang and somebody from the outside told us whether or not there was or there wasn't. And so it was about 8:30 and 30 seconds. And every single phone on the floor, it was like it rang all at once. And the rings, these phones, first of all, they were the institutional metal phones with push buttons. There were 6 buttons on each side. So each phone had the potential of 12 lines coming in. And the boot space was only as wide as my shoulders. And so I had 2 phones, one stacked on top of the other. So I potentially had 24 lines to go out, right?
Wow.
And when they rang like a telephone used to ring, like a ring, right? Today it sings songs and it does all that shit. It didn't do that. It rang. And so when they all rang at the same time, it was, you could feel it immediately. Like you could feel the energy coming through the phone, right? And so you pick up the phone, and when I picked up the phone, it was a guy I picked up the phone to a buddy of mine at First Boston who was ringing the phone.
Yeah.
He goes, "Did you see it? Did you see it?" I go, "No, I didn't see it. What happened?" so he tells you what happened. He goes, "The Fed came out." Paul Volcker was Fed chair at the time. Paul Volcker opened the door, stepped out, got to the podium, and made the announcement that the Fed was cutting interest rates by 10%. Dude, 10%, that's 2 full percentage points. When rates are 21%, 10% is 2 percentage points. That's a massive move.
Incredible.
That's a massive move, right? I mean, today we're talking about rates going up by 1/4%, and everyone's having a nervous breakdown.
What was the Fed usually cutting? Well, they weren't cutting.
Well, they weren't,
right?
They weren't. They were actually raising rates into 1982, right?
Wow. So just this drastic change, and
it was a complete change in policy, and what the Fed's mission was. They were going to break the back of the inflation. They were going to break the back of economic malaise. By cutting rates, they were going to do what? They were going to force money out of the banks and into the market, very much like what they did in the crisis of the great financial crisis of 2007, 8, 9, 10, 11, 12, 13, 14, 15, 16, right? Where they cut, and they forced money out of the banks, and look what it's done. They forced money into the market, and today we're trading at Dow 30,000, right?
Yep.
And so that's what they did. And the Dow on that Tuesday every phone rang, and then the orders started coming through. And the orders weren't to buy 500 shares of General Electric or 1,000 shares of American Telephone. It was buy 50,000 GE, buy 100,000 telephones, buy 50,000 IBM. It was crazy, right?
Wow.
Now, at the time, I was 20 years old, but I stood there from 8:30 in the morning when the announcement came out till 4:30 in the afternoon, and all you did was pick up the phone and take orders, and the order just buy. And the market exploded. The market went up 4.5%. 4.5% was 35 points on the Dow. 35 points. Think about it. Today, it's like nothing, right? But when you think about the percentage move on the Dow today would be, 1,800 points or 1,600 points, whatever it is, right? Which also we've done.
Yep.
But we've done that with the help of technology. We did 4.5% by pen and paper.
Wow.
Face-to-face negotiation. So it was amazing. It was amazing. And remember, I said to you on Monday, we traded 30 million shares, which was a typical day. On Tuesday, we traded 138 million shares.
Oh my God.
On Tuesday. So we did 4 times the volume. The market rallied 4.5%. And we were there until, 8 o'clock at night, going through tickets, writing reports, confirming trades with other brokers. It was absolutely nuts, right? But it was one of the greatest days of my life.
That's incredible.
Now, like I can still feel it. I tell that story and like I can feel the energy in my body. I could feel it like it was yesterday, right?
Now, at that point, did everyone, especially for those who were on the exchange for a while, was there just a feeling like everything's different now for stocks, for exchange? It's a place to be now.
Everything was different, and that was the birth of the greatest bull market that this country and the world has ever known, right? Because that was real. If you go back and you look at the charts, that was the day it was born. And so then 2 weeks later, I was scheduled to go back to college, my senior year in college. And so the guy I was working for didn't want me to go back to college because now his business was just blowing up.
Yeah.
And now I had spent 3 years. I'd spent $30,000 because college was $10,000 a year. Then all in $10,000 a year. I was going to BU. I was going to community college. I was going to BU, right?
Yeah.
And I said to him, look, I really want to go back and finish college. He goes, why don't you just transfer, go to NYU at night? I go, dude, listen, I know myself. I could not work in this environment all day and then go sit in a classroom for 3 hours every night. It would take me 10 more years to finish. No way, I'm not doing it. So he said to me, no problem. He said, listen, I get it. Go back to college, have a good time, have a great senior year. You have a job next May when you graduate. Is $36,000 a year okay? $36,000 a year in 1983, I hit the lottery again.
Yes.
Right?
Yes.
I went back to college in September, clicking my heels because I had this job 9 months out when I already said to you, kids couldn't get a job coming out of college, right?
Right.
And so what I didn't do, and maybe this is one of the lessons that I should tell you anyway, what I didn't do when I went back to college that year was I didn't write a resume. I didn't go through the process. I didn't force myself to go through like the interview process and all that stuff because I had this job that I so wanted. Right. I thought to myself, why would I want to screw it up and go on an interview somewhere? Yeah. But in retrospect, that was probably a mistake only because who knows? Who knows what could have happened? I could have gone on an interview at Goldman Sachs and maybe I would have been the next Lloyd Blankfein. What the hell do I know?
Walk us through a scenario of that, of just, so you're on the exchange, you have your order and you're trying to, get the best price for your client.
Well, so I'm trying to get the best price. Now say you're my client, right? You call me up, you say, Kenny, I need to go out and buy 50,000 Coca-Cola. Maybe you've got a $40 limit. Right? You might have a $40 limit, but the stock's trading at $39.25, but you ultimately have a higher limit.
Right.
Okay. That's fine. So I know that. I have the order in my hand. I know what I have to do. I understand it. But I would walk out to the crowd and you'd walk up to the specialist, and Coke was a fairly busy crowd all the time. It was a big stock. It was a big option stock. So it was always action in Coca-Cola, right? Okay. And so you'd walk into the crowd, you'd say to the specialist, how's Coke? And the specialist would represent his his order flow, meaning what he was in control of, what was on his order book. And it was physically an order book. He would pull it down off the shelf. He'd open up the pages.
Oh, wow.
There was no technology. There was
Yeah.
no computer screens, any of that shit.
Yeah.
It was a book, right? And so he would open up the book and he'd say, 39.25 bid, off it at a half, 5,000 by 10,000. So that means he could pay 39.25 for 5,000 shares, and he could offer 10,000 at 39.5. That was the market. But then he'd say, there's two buyers in the crowd and one seller. And so then it was who are representing themselves. So then it was up to me to have the conversation with the buyer, with the other buyer, with the other seller, to gather a picture of really what the market was. So I might say to the two buyers, what are you guys doing? Guys is generic because it could have been a female broker, but I'd say, what are you guys doing? And so one might say, I'm a quarter buyer. So a quarter buyer means I can pay 39.25. I can't pay 39 3/8. I can't pay 39.5. I'm a quarter buyer. He's indicating that he's limited to a quarter. He said, I'll bid for 10. Now, he's not lying. He might have 100,000 to buy with a quarter limit, but when he says I'll pay a quarter for 10, he's not lying because that's what he's willing to do.
Yep.
He's not sure what he wants to do with the other 90,000 shares yet because he wants to see what I'm doing. Am I a seller? Am I a buyer? If I'm a buyer, then I represent competition. So he wants to say less to me versus more to me. If I'm a seller, then he wants to engage with me more because as a buyer, you're looking for a seller. As a seller, you're looking for a buyer. If I'm a buyer, I'm not looking for another buyer.
Right.
I'm looking for a seller. Right?
Right.
And so then the other buyer might say, I'm a go-along bid. A go-along buyer, go-along bid meant, okay, I'm bidding a quarter, but I could pay 3/8. I could pay a half. I really have a market order.
Wow.
Right?
Oh, yes, exactly.
Now, he may not indicate the size yet because, again, he doesn't know what I'm doing. And then I'd turn to the seller and I'd say, what are you doing? And he says, that seller might stand up and say, listen, I'll offer 50,000 at a half. So he's offering 50,000 shares of Coke at 39.5. He's willing to offer it. He's willing to say it. He says it out loud. He's made it very clear what he's doing.
He's very eager to unload those shares, or he could be bluffing at that point. Or?
No, he's not bluffing. Well, he's not bluffing because once you make an offer, you make an offer.
You make an offer, right?
You can't because if I say take them and you go, oh, I'm only kidding. It doesn't work that way. So no, that's not bluffing.
Okay.
But he might have 250,000 more in his hand. Okay. Now I don't know that.
Yep.
And the reason he's not going to tell me that again is because why would he tell me until he knows what I'm doing?
Right.
So I might say, listen, the minute he offers 50.5, I might say 3/8 for 50,000. Why would I say 3/8 for 50? Because there's already a quarter bid and the guy's not hitting the quarter bid. And if I bid a quarter, it just makes the quarter bid bigger. And I want to buy stocks and I'm going to tighten the market. So the increment in between a quarter and a half is 3/8.
Okay.
So I'd say 3/8 for 50. So now the two quarter buyers are out because I'm willing to pay 3/8. And so the guy who can buy, the go-along buyer, he might step up and say, well, I'll pay 3/8 for 20,000. So now it's 3/8 for 70,000. I'll pay it for 50. He pays it for 20.
Yep.
So now you look at the seller and you say, listen, it's a 3/8 bid for 70,000 because he might have more for sale.
Mm-hmm.
And so he might say 70,000 at a half, or he might say, I sold you 70,000 at 3/8, 50 at a half. Which what means is he just sold 70,000 shares at 3/8, of which I bought 50, the other guy bought 20, and he reoffered 50,000 at a half, which clearly tells you he's got more for sale. But guess what? I might say a quarter for 50 after I buy stock at 3/8, which clearly means I got more to buy.
Yeah.
You understand?
Yeah.
And so
is that negotiating going back and forth?
But you have to understand this is happening very quickly.
Yeah,
right.
That's
I'm making a bid. He's making an offer. We're trading. I'm rebidding. He's reoffering. The other guy comes in. He makes a bid. Another seller comes in. What just happened? 50 traded 3/8. I'll sell stock at 3/8. And so now now there's a new seller at 3/8. Plus the guy at a half already sold stock at 3/8. I'm not going to pay 3/8. Now I'm going to bid a quarter because now that looks like there's sellers coming in and maybe they're going to hit the quarter bid. Now listen, every tick was 12.5 cents. So between an 1/8 and a quarter is 12.5 cents. So if I bought stock at 3/8 and then I bought stock at a quarter, once you average it out, I'm buying stock in the middle there, right? At whatever it is, 15.5 cents or whatever the number is, right? But that went on all day, every day, depending on the news in the stock that day, depending on what was the news in the market that day, what was the news in the industry, was it earnings season, was it weak macro data, was it strong macro data, because that was happening in every big stock.
Yeah.
Right? Listen, it wasn't necessarily happening in Bank of Hawaii because who the hell wants to buy Bank of Hawaii? So there's no interest in Bank of Hawaii. But General Electric, American Telephone, IBM, Johnson & Johnson, Procter & Gamble, Abbott Laboratories, United Healthcare.
Yeah.
All those were very big market cap stocks. So they were constant, they were big traders, right?
Yep.
And listen, Coke wasn't the only order I had in my hand. I might have an order. I might be a buyer in Coke. I might be a seller in ExxonMobil. I might be a buyer in IBM. And I have to go running around from stock to stock, representing buyer, seller, right? And so now I'm a buyer in Coke, and I run to IBM. I'm a seller in IBM, but IBM trades different from Coke because it's a different price. So that number one, it's going to trade differently because it trades at $100 a share, not $40 a share.
Mm-hmm. Is that where the when people say the feel for the market, you're developing a feel for the market, because that is intelligence right there. There's that floor intelligence that you can hear and feel and
feel it. Yeah. You know when you go to a concert and you're close down to the stage and you're standing in front of the speakers, and when they start to play the music, you can feel like the music coming, like the vibration coming out of the speakers. Yeah. That's what it felt like every day. You could feel that energy. Wow. Now, if the market was up, it was one energy. If the market was down, it was a different energy, yet it was energy, right? Yeah. You could feel it. You had a feel for the market. You had a feel for when you walked into a stock, you could tell right away there were 3 sellers and there were no bids. You could feel the anxiousness in the market, right? Yep. And so it was an art. It was an art that you honed. It was a skill that you honed how to feel it, how to read the tape, how to understand what was going on. And look, what everybody really misunderstood. And this was always an argument. Everybody thought that the specialist controlled everything, that the specialist stood at the point of sale. So he was going to pick the price of stock open. He was going to pick the price of stock closed. He knew exactly where it was going to open and close every day. If that was true, they'd all be trading for one day if they knew exactly where it was going to open, where it was going to close. Right. Right? That's
so I guess you're not a fan of the efficient market hypothesis then.
No. So I'm a fan of the efficient market hypothesis. What I'm saying is I'm not a fan of the people that would say that the specials controlled where the stock went.
Oh, fair enough. Yeah.
Because here's the deal. If you were my client and you called me up and you said, Kenny, I got to buy 500,000 shares of Coke in the next 10 minutes. Now, I don't care why you had to do it in 10 minutes. It was none of my business. You said I have to buy it in 10 minutes. Okay, great. Well, let me ask you a question. Chris has an order of Coke that he's going to spread out for 6 hours.
Yeah.
And I have an order of Coke that I have to buy in 10 minutes. And it's not 1,000 shares. It's 500,000 shares of Coke. And Chris has 500,000 shares, but he's got 6 hours to buy it.
Yeah.
So when I walk into Coca-Cola, am I going to be able to be like Chris and sit back and be patient and wait? Or do I have to be a tad bit more aggressive because I need to start to buy stock?
Yeah, you're going to drive up that price fast.
And so bingo, you just said it. Who's in control of the price of that stock at that moment in time? Not the specialist.
Right.
I'm in control. Right. But guess who's really in control? You're in control because you're the client who gave me the order. So when I walk into Coca-Cola and I say, how's the market? He goes, I'm a quarter bit off at a half. I go, take him at a half. So I bought 30,000 at a half. Great. How's the market now? I'll say I'm a half bid for 10,000. He goes, okay, it's a half 3/4. It's 50 at 3/4. I'll say half of 50. He goes 50 at 3/4. I go half of 50. Someone goes 10 at 5/8. I go, I'll take 10 at 5/8. I'm a half of 50, 50 at 3/4. Someone else says 10 at 5/8. I'll take 10 more at 5/8. Wow, I'm a half of 50, 50 at 3/4. Take the 50 at 3/4. So now I took the 50 at 3/4. So now I bought the stock at a half. I bought stock at 5/8. I bought stock at 3/4. Next thing you know, I'm buying stock at the figure. Who is in control of the price of that stock at that moment in time? Me.
Right.
Hello,
exactly. You're driving it up. Yeah.
I'm now. If I were
now,
a seller,
you might be attracting other people might be seeing this, and they're probably going to try to hop on to go for the ride. Right?
Exactly the point. And so what would happen is other brokers that might be in the crowd, legitimate guys that were bidding below when I walked in, they're going to go because they have a responsibility to the client they're representing. They're saying, listen, Bear Stearns, because you would never say Kenny's in the crowd because I was giving up Bear Stearns or First Boston or Goldman Sachs. They would go back to their client. They say, listen, Goldman just came into the crowd. He's taking stock up to 40, which means he's an aggressive buyer. And that guy might say, listen, take the limit off and go along. Yep. Become a buyer with Goldman Sachs. And so all of a sudden now there's 2 people. And so who's driving the price of that stock? Not the friggin' specialist. Right. Not at all.
Right.
It was the bids in the, now listen, if I were a seller and I had to sell 500,000 shares in 10 minutes, it would work the other way, right? I'd hit a bid, hit a bid, hit a bid, hit a bid, because I had to sell stock.
Yep.
Now, at some point, I might say to you, I might take the stock up $0.50, which was a big move, even in Coca-Cola in 1983, 1984, 1988. Taking the stock up $0.50 was a big move. Because what would happen? You take the stock up $0.50, and that would create interest on the other side as well. All of a sudden, somebody, you're Alexis is a portfolio manager, and she owns Coca-Cola, and in her mind, if Coke starts to trade at $40 or higher, she wants to start to peel out of some of the stock that she owns.
Yeah.
Now, all morning long, it's trading at 39.5. So she goes, no, screw it. I'm not going to sell stock yet. Suddenly it's trading at 40.25. And she goes, holy shit, I got to sell stock. And she calls up her broker and she says, sell 100,000 with a 40 limit. So it would create new order flow depending on the price. That's why it was so dynamic. It was so exciting. It was, I can feel my heartbeat, right? I mean, it was, I could feel the sweat dripping down my back, because that's the way it was every single day. It was the most amazing experience. Anyway, so that was August 17, 1982, and the market, took off from there. And then the market proceeded to trade. The Dow went from 792 to 2,800 by the summer of 1987, which was a dramatic percentage move in the market, right? But it happened, it happened over 5 years, but it was still a dramatic percentage move.
Stay tuned. We'll take it after the break. We'll take it from 1987 and on. Stay tuned.
MarketSmith will give you a huge edge in the stock market. Better stocks, bigger profits.
MarketSmith is the top research platform for IBD.
It's just the best tool for individual stock selection.
Everything within MarketSmith is designed to bring those best stocks to the surface.
It does a lot of the work for you of filtering down to the potential leaders.
It's when you take the training wheels off and you're ready to invest on a more professional level.
MarketSmith will help you take control of your investment life.
If you want to get serious about investing, start your membership today.
We are back on Investing with IBD, sponsored by MarketSmith, here with Kenny Polcari. Kenny, now let's go to 1987. And so let's go over something significant. Obviously, we all know what happened in 1987, but there was a major kind of catalyst behind that that's affected the market since then. And then we'll go into 3 of your stock ideas.
Okay, so what's significant for everyone to understand is 1987, the crash of 1987 was really at the very beginning of the advancing technology and the role that technology was going to play in the markets. And so it was a failure, but it was actually a human failure. You can blame it on technology if you want, but in fact, when you hear the story, you'll realize it was really a human failure. But as we moved into 1985, 1986, 1987, when the Dow went from 792 on its way to 2,800, there were huge gains in the market. They represented huge gains from people, stockholders and shareholders and mutual funds and all that stuff in the market. And so there was a group of they were quants, right? The quant industry was just being born, right?
Okay.
And computerization and automation and algorithms and all this stuff. Now, I missed it in high school and I missed it in college because I happened to be on the front end at both, right? So I didn't have any computer skills in high school because it didn't exist. And when I went into college, I was studying business, and using computers and all that stuff wasn't kind of part of the curriculum, right? Mm-hmm. So again, I missed out. But one way or the other, 1985, 1986, it became, the computer science became like the new buzzword and all that stuff. And so there was a group of quants, and they were engineers, they were physicists, they were mathematicians, they were everything but economics majors or finance majors, right? They were all these brainiacs, right? They were all these rocket scientists. And so what they developed was this thing called portfolio insurance. And insurance is just what you know insurance to be. It's a product that you buy to protect you against a loss. Health insurance, disability insurance, life insurance, right? Car insurance, whatever. It protects you against a loss. And so what these guys did was design a product built off of an IBM mainframe server that, probably took up, 5 conference rooms, because that's how big those servers were at the time. And what they wrote was they wrote this computer program that used to take in all this data. and the data would be data from around the world. It would be macro data. It would be individual company data. It would be pricing data. It would be interest rate data, central bank policy data. Took all this data and they would feed it into the computer. And if the computer, if there was something that the computer thought raised the eyebrows, meaning the market was on the verge of selling off, it would initiate an instruction, right? It would tell you to do something.
Okay.
So if you were a mutual fund or a hedge fund or an asset manager that bought this product, then you were privy to that signal. If you were somebody who didn't buy the product, you wouldn't get the signal, right? And so they wrote it, they tested it, they wrote it, they started to sell it, they sold it to asset managers in America, they sold to asset managers around the world and Asia and Europe and whatever. And the product, like a lot of insurances, never got elected, right? There was never really a trade to say the world was falling apart. It's like if you never die, your life insurance never gets paid out, right?
Right.
And so as the market came in, as we came into the summer of 1987, the global markets had rallied. The global economy was strong. But once again, remember, the global economy, although it was connected, it was not connected in the way we're connected today in terms of the way information travels. And so over the summer, the U.S. economy started to falter a little bit. The economic data started to get a little bit weak. It started to get weak, but it wasn't disastrous. But, the Dow would sell off a little bit, and then it would rally, then it would sell off a little bit. And the earnings season was a little bit weaker than expected. But it was nothing that was really causing concern after the move that the market had made, right? And so, and it was happening not only in the States, it was happening around the world. The global economy was starting to come under some pressure. So August came, the market got weak, and then September came, it rallied back a little bit, and then end of September into October came, the market started to get weaker again. We got into the midweek of October. It was the Wednesday, Thursday, Friday. It was the 14th, 15th, and 16th of October, 1987. And on the Wednesday, the market came under pressure. And it didn't bounce. It came under pressure, kept selling off. It closed on the low of the day.
Okay.
And so it was concerning because then it was a big deal because, the market moved 70 points on the Dow. It was a big move, right? Mm-hmm. And it closed on the low. And so then you came to work on Thursday and the market came under pressure again. And global markets, Asian markets had been weak and European markets were weak. And the U.S. market got weak again. It came under pressure. And as the day wore on, the pressure, it started to build on itself. And as we went into the close that day, the market once again closed on the lows. And then Friday came.
Yeah.
And Friday, global markets were really under pressure. And U.S. markets once again came under pressure and they opened lower and they traded lower and then they stabilized a little bit and they tried to rally and then they got hit again. And they once again closed on the lows on Friday, the 16th. And I remember going home that night and I remember saying I was 26 years old and I had just gotten married. My daughter was just born. We had just bought a house. I had 2 cars in the driveway and a white picket fence. It was like, I arrived, right?
Right.
And I remember going home and I remember saying to my wife, because by now she had left the floor, right? She had retired from being a member because stay home with the daughter and all that stuff. And I remember going home to her on that Friday night and I said, you know something? I don't know. But something tells me there's something going on. Like it doesn't
now,
feel
Kenny, did you ever, how often did 3 days in a row, the market finishing at the lows that week? It
might have happened in the crash of the Great Depression, but I wasn't there.
Right. Yeah. But because you were it's like 7 years in, right? You've never seen that. Never seen the market do that.
Yeah. I was also 26. It wasn't like I had a lot to lose because I didn't have any money, right? And so, but I remember going home and saying to my wife, I don't know, something just doesn't feel right. But it was Friday night. Halloween was 2 weeks away. My daughter was 6 months old. We did the whole pumpkin picking thing and we cut the pumpkin and blah, 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 blah. And now Sunday night, I go to bed. Now I go to bed. It's 9:30 Sunday night. I get in the bed. I turn on the TV. Okay, I'm just watching the news. Not a big deal, whatever.
Yeah.
But remember, Sunday night at 9 o'clock in New York is Monday morning, 9 a.m. in Asia.
It's just opening.
Okay. So it's already Monday. When I'm going to bed, it's Monday morning in Asia.
Yeah.
So what had happened over the weekend is that this portfolio insurance product, these guys took in all the data from the week, the pricing data, the macro data, blah, blah, and they fed it into Watson, or it wasn't called Watson at the time. They fed it into IBM, right?
Yeah.
And on Sunday afternoon, the computer spit out an action. And the action was if you bought this insurance product, you got a message that said that you needed to sell 2% of your portfolio to raise cash to protect the portfolio, because this way you raise cash, you put it over here. If the market gets weaker, then you can put that cash back to work, right?
Right.
So who's the first one to get the message?
Yeah.
Not the Americans, because we were sound asleep. It was Sunday night.
Yeah.
The first ones to get the message were the Asians.
Right.
So the Asian markets, any portfolio manager in Asia got a message. You got to sell 2% of your portfolio. Okay, you're in Asia. You manage 100 million yen or whatever, and Chris manages 1 billion yen. So his 2% is different from your 2%. But the fact is, it's 2%, right?
Oh my gosh.
And so you start to sell stocks to raise cash. Okay, so what happens is the Asian markets came under pressure. But then what they realized, these portfolio insurance guys, was because the Asian markets had this drastic reaction, because the Asian markets started to fall out of bed, that they ran the Asian pricing data back through the system.
Oh gosh.
And the Europeans got a different message. Their message was they had to sell 3% of the portfolio based on what had happened in Asia. Which means what? So now the percentage just went up.
Yep.
And so now what's going to happen? The European markets are going to come in under even more pressure, because everyone gets a sell order, not a buy order. Everyone's getting a sell instruction. Well, at least everybody that bought the product is getting.
It seems like a lot of people bought this product.
Well, what ended up happening was, as you recognized what happened in Asia, and the sense was the European market was going to come under pressure. Naturally, what happens? Buyers don't just stand there and get run over by a train. They back off.
Right.
Okay, there are buyers there, but instead of paying 50, I'm going to bid 45.
Yep.
So there's this void in prices. And
Yep.
suddenly the European markets open, and their message was to sell 3%. And so their orders were bigger. And so the European markets fell even more. And so now I get up, it's 5 o'clock in the morning. Now, Asia's already closed, open and closed, right? Monday's already gone for Asia. Their market closed down, whatever it was, down 5%, whatever it was closed down. European markets are now under assault. I get up, I take a shower. 5 o'clock in the morning, I shower, I shave, right? I get dressed, right? Yeah. And then I get in my car. I go down to the train station. I get a cup of coffee, and I pick up the Wall Street Journal. Okay. The Monday morning Wall Street Journal tells me what? Tells me what happened on Friday.
Oh my
It
gosh.
doesn't tell me. Monday's already come and gone in Asia. I'm not reading about what happened in Asia on Monday. I'm reading about what happened in Asia on Friday.
So you still
had
don't
no idea.
necessarily know.
I had zero idea.
Wow.
Now I'm on the train. I'm drinking my coffee. I'm reading the newspaper. Not a big deal. I get off the train. I get in the subway. I get to the floor of the New York Stock Exchange at 7 a.m. I get to the floor of the exchange. There's hardly anybody there at 7 a.m. All of a sudden, the phone rings. Well, look, the phone never rang at 7 o'clock in the morning unless somebody died. Because, right, the phone never rings at 7 a.m. in the morning because the market's not even open. And you can, this is actually on YouTube. You can Google, if you go to YouTube and you Google my name, Kenny Polcari, Crash of 87, you're going to see somebody actually made a cartoon out of this story that I'm going to tell you right now. This is the story I'm going to tell you, and you can find this on YouTube. Somebody actually made it's actually very funny. So the phone rings at 7 a.m. in the morning, and it's my buddy from First Boston. And now he's sitting up on the trading desk at First Boston, where he has access to Bloomberg and the global markets. Now, he knows I don't, because there were no Bloomberg machines on the floor of the exchange. There was no television, no radio. And I'm reading a newspaper that tells me what happened 4 days ago, right?
Right.
And so the phone rings, and he says to me, bro, he goes, it's going to be a bloodbath. I go, what's going to be a bloodbath? What do you mean it's going to be a bloodbath? What are you talking about? Yeah. He goes, do you have any idea what's going on? I go, I have no idea what you mean. So he begins to tell me about the disaster in Asia and now what was happening in Europe. And he said, it's going to be a bloodbath in the U.S. markets today. And I sat there and I'm trying to, in my mind, I'm trying to define a bloodbath. I have no idea what he possibly could mean other than we were just going to get hit with, because he was now telling me about how Europe was just spinning out of control, right?
Mm-hmm.
I think European markets at the time were down 12%.
Oh my God.
And he said, it's going to be a bloodbath. And so now I prepared. Now I'm standing there. And all of a sudden it's, 8:30, and all of a sudden the phone starts to ring and people are starting to enter orders at 8:30, which was another thing. People never entered orders at 8:30. It was way too early. The market didn't open until 9:30. But what happened was the same portfolio insurance guys, they now took the data that was happening in Europe, and it was still happening live because Europe markets are still open. And they were feeding that data back into the computer system. And guess what the message was for the American asset managers that bought this product? 5%. You have to sell 5% of your portfolio. And so you see how the numbers grew exponentially.
Yeah.
And so now you as an asset manager, here you spent money on this product that says you have to, the product's telling you to do this, so you have to do it. So now you're a human being, you got a brain in your head, but now the computer says you have to do this.
Yep.
Johnson & Johnson closed at $96 on Friday afternoon, October 16th. It closed at $45 on Monday night, October 19th. It lost 50% of its value in 6.5 hours.
Wow.
What do? Johnson & Johnson makes baby powder and baby oil. Are you kidding me?
Right.
But what happened was people sold what they could versus maybe what they should have, because they couldn't sell what they should have. Who the hell wants to buy Bank of Hawaii when it's under pressure? Nobody. But you could always sell Johnson & Johnson because it was a big market cap stock.
Right.
But here's the point. You were happily buying Johnson & Johnson at $96 on Friday night. On Monday, it opens at 90. It trades down to 85. And you're sitting there going, wow, it's trading at 85. This is down 10 points. It's got to be a buy. Yep. So then all the trader types come in and they start to make bids, and then boom, they get whacked. And then it trades down to 75. And they go, well, at 75, it's got to stop now. Nope. Boom, it gets whacked. But now you're on the sell side of that trade. You're the guy that's listening to his computer say, you have to sell, you have to sell, you have to sell. And you're saying to yourself, wait a minute. Johnson & Johnson is trading at $65. It's down $30 from Friday night's close. Wait, full stop. There's something wrong. But instead of saying that, you kept, because I would, as the broker representing it, I'd call you up and go, Arusha, are you sure you want me to keep selling this?
Yeah.
And you'd say, sell the goddamn stock, sell the stock. You're screaming at me to sell the stock. Stop talking to me and sell the stock. Okay. And so you go out there and you sell and you sell and you hit another bid and you hit another bid. And next thing you know, the stock is trading down $50.
And it's not just you, it's everybody.
It's not just me.
Every fund manager out there.
Every broker in the room is getting screamed at by the fund manager, sell the goddamn stock. Okay.
That's incredible.
And so what happened was, instead of people going, wait. They didn't. It was like they took the brain out of their head and they put it over here, and they just did what the computer told them to do. Now, listen, there were no circuit breakers at the time. Circuit breakers were born out of this event, because then everybody realized what the hell happened is that this technology spun so far out of control that nobody had the wherewithal to say, wait. There's something wrong here. It's not nearly this bad, because by the end of the day, the Dow lost 22.5% of its value in 6.5 hours. And that was the broad Dow. Individual names like Johnson & Johnson lost 50% of its value.
That's incredible.
And so the point of this story was that technology, that portfolio insurance, was an algorithm that was written by guys who had no idea how the market worked. They were physicists and engineers. They had no idea how the markets work. They didn't study economics and finance. All they know was, if A, then B, if B, then C, like a flow chart used to be, right?
Right.
And so out of that event was born, everybody turned around and said, okay, what just happened? Right. And so the industry in the country then built in circuit breakers were born out of that event to prevent exactly that from happening.
Which is what we saw like in February, right? The circuit breakers went off left and right.
Circuit breakers went off left and right. And circuit breakers have gone through a number of iterations since they were born in 1987, in terms of how we calculate them today versus how we calculated them then. And part of that is because the advances in technology and the speed at which stocks trade and the venues in which you can trade them at. And so there's a whole different set of rules today, but yet circuit breakers were built out of that event. And so what was key about that event is that it was this technological program that was built that started to dictate to portfolio managers when to sell stocks, and and the weaker stocks got, the more pressure it put on it, right? Because selling begets selling begets selling. And so as prices broke down, the computer would say, you have to sell more, you have to sell more, you have to sell more. Because in order to raise the cash, as prices got weaker, you had to sell more.
Yeah.
Right? And so
self-fulfilling prophecy.
It was a self-fulfilling prophecy. And what it really brought to light in retrospect was how the human beings didn't go, wait, full stop. There's something wrong here.
Yeah.
Right. But they didn't. And so out of that event, the market lost. Listen, there were people that got wiped. Some people got wiped out. I remember I said I didn't have any money to lose. Although I thought that was it. I thought I was out of a job. I was going to lose my house. Because I thought like the world came to an end.
Right.
And the world clearly did not come to an end. But there were plenty of guys who were my age then. Oh my gosh. Who had money in retirement accounts that was invested in the market that saw 50%, 22%, sometimes 30, 40% of their retirement funds just wiped out. And there were guys who were 60 years old who were going, holy shit, I don't have time to wait to make this up.
Yeah.
I mean, there were guys that just got absolutely decimated, right?
Yeah.
And so it was a really, I mean, listen, I remember that day too, like it was yesterday. Like I can feel the emotion in my body when I think about what I felt during the day that day and the pressure that the market was under and the looks on people's faces and the real fear, right?
Yeah.
Anyway, so listen, you and I could stay and talk for 3 more hours because I'm still not even in the 21st century.
That's true. So Kenny, let's take a break. Then what we'll do is we'll come back very quickly and we'll go some stocks. And I think a good segue to this is we'll talk about tech stocks. So we'll go over a few tech stocks very briefly and we'll be back. Okay, so stay tuned.
I am here with Scott St. Clair. Scott's one of our senior product coaches at MarketSmith. Now, Scott, there are a ton of publicly traded stocks. Just on the U.S., I think it's over 5,000 stocks. Who has the time to go through all of these stocks and find the very best ones?
Yeah, most people don't, right? So what you need is a tool like MarketSmith. We have decades of research on what makes a great winning stock. So we've done all the research for you. So we're going to try to highlight those specific stocks with those great data points. So if you're looking for that next great potential big winner, orange stock ideas button, you just click on it and you've got some of the main reports that we use, including the Growth 250.
Yeah, and the Growth 250 is the first list that I go through on the weekends.
Yeah, it's the most popular one, but there are others. There's the Breaking Out Today, Stocks Near a Pivot, and then the Blue Dot list, right, which is very popular. It's going to show you the stocks with the best relative strength. So we've done a lot of the work for you. What you have to do is review these lists. You're going to come up with some of the best ideas in that current market environment.
Perfect. MarketSmith saves you time and makes investment research that much easier. For more information, go to investors.com/podcast2020.
Welcome back to Investing with IBD, sponsored by MarketSmith. And we're going into a bonus fourth segment here of the episode. And we're going to get into some stocks here pretty quickly. And so, Kenny, we're going to go into team technology stocks since you excited all of us about technology and how it could change the markets back in '87. Let's go into a theme here and the Internet of Things, right? This is only going to be growing and growing. So walk us through. The first one is an ETF, and the ticker symbol is SNSR.
Right, sensor, right? So
Yes.
the Internet of Things, just so everyone understands, is that part of the internet that connects all these things that we now live with. So it's your iWatch, it's your Nest thermometer. It's your
thermostat
ring
and all that
central. Yeah, it's your ring central that
Yeah.
the cameras you put around your house or your front door and your doorbells and all the stuff that connects us, the things that talk to your washing machine and your refrigerator, tells you you're out of milk and all that stuff, right?
Yeah.
That's the Internet of Things, right? And so in my mind, when people talk about technology, most people think about the FANG stocks as if they're the only 5 names in the whole space of technology.
Right.
Meanwhile, they are not. Let's make that very clear. While they garner all the attention, there are so many other opportunities in the tech space in order to allocate dollars to and allocate investment dollars to, right? And I think the Internet of Things is just on the cusp of being an opportunity, being a place that investors should have in their portfolio. And certainly, at 60 years old, I might have a different allocation than a 30-year-old might have.
Right.
But as a 30-year-old, I think if you want to put money into tech and you're looking for a place to put it, I think the Internet of Things, and listen, that includes software, it includes communication devices, it includes the devices themselves. So there's a lot of subsectors within that you can find places to put money. But if you want the broad exposure, SNSR is an ETF that gives you that exposure. And in fact, today the market got hit, but this thing was only down 9 cents, partly because, did it get hit? Yeah, it got hit a tiny bit, but it didn't get hit more because what it represents is it really does represent the future. It represents opportunity. It's part of its artificial intelligence, part of its, all this stuff that the future is going to be. And so you look at other stocks like, you look at other ETFs. The XLK got whacked today. That was down 1%. The XLK. The SNSR wasn't even down. It was down 9 cents. So what was it down? Not a whole lot in comparison, right? And so I think that's a place that you look. And then within that, if you look at some of the names within that, and I think I gave them to you, didn't I? Give them
Yeah. So let's go into one of these names. This is Sensata Tech, ticker symbol ST. And so what do you like about these guys?
Sensata Technologies.
Sensata Tech. Yep. Sorry. Yep.
Sensata Technologies. And so, wait, it's ST. Is it ST Sensata Technologies?
ST. Yep.
Yeah. So, right. So what these guys do is they manufacture the components that go into a lot of this, a lot of these sensors, the automated sensors, the things that are communicating into the Internet of Things. And so there's it trades at $48 a share. I think if you look at it on the chart, let me just pull it up. If you look at it on the chart,
I could pull it up here on a MarketSmith chart right over here. So I just pull it up on a weekly chart here.
Yeah, so you can see where it is. When I look at it on my Bloomberg chart, it's well ahead of all 3 trend lines, the 50, the 100, and the 200. And it's testing. It's just pulling back a little bit, but that makes sense because the market's pulled back a little bit, but it's by no means breaking down in my mind. You look at some of these other stocks that are some of the other tech names, the big names that you're always talking about. Some of them have already broken through the 50 and the 100-day moving average. And so technically they're kind of broken. And so you'll get algorithms that will react just because they've broken down. But like a stock like Sensata Technologies, you can see is still holding its own even in today's weak market. I suspect if the broader market gets weaker, this will come under some pressure, but it will also be very quick to rebound because of the space that it's in, right? I think I don't think it's it's not Facebook, it's not Twitter. It's in my opinion, it's much more important to where the world is going, where technology is going.
Perfect. Let's go to another one. This is Skyworks, ticker symbol SWKS.
This one actually it was hanging right in between its 2 technical trend lines. Today it did break down. It did break down a little bit. It is this stock does as well. It's a wireless semiconductor company, right? So it designs and manufactures the stuff that allows these things to talk wirelessly to each other. Again, I think it's a very interesting space. Yes, did it come under some pressure today? Yes, has it broken down? But look at right on your chart there, 134.84 would be a level that you'd think it would find, or it should find some support. And if it does, then I think it holds that. And once again, it'll advance from there. But I think, look, I think when you think about any of these things, you have to think about where the market is and kind of the overall tone in the market. And right now, there's still a lot of angst in the market due to kind of an unfinished political season. And I'm not talking about the presidential election. I'm talking now about the Georgia state election, which could then flip the balance of power. And so I think there's some volatility in the days ahead. But if you still have, and we have this conversation, if you've done your homework and you've got stocks that, the story is right, the fundamentals are right, then unless they break down or unless the story itself changes, there's an opportunity to pick up some stock, and you might pick up some stock relatively cheap compared to where it's been trading. Right?
Perfect. And so one more, Qualcomm, which we all know, they're major player. They've been a major player for many years, but is 5G is here, and of course also Internet of Things. They play a big role.
Right. Now look at this huge gap here, right?
Yep.
So my sense is you got to be careful with this one. Just as much as I like it, you got to be careful here, because there is going to be a tendency for the stock to want to come back and fill this gap at some point. Now, my guess is we may see that happen this month, because if the market gets anxious, because of that gap, this will come right back. But if it comes right back, I think right in here at this line, right in here,
right around here,
right there,
or the 50-day moving average around there.
Yeah, right in there is where you would look for it to play. So I wouldn't be so quick to go chasing Qualcomm at the moment. I like it, but I like it on a pullback, and partly because of this gap. You have to, and because of the anxiety in the market, I think you can be patient with this, but I think you're going to have the opportunity.
No, it makes a lot of sense. I mean, that stock has gone up on a really big run, and so could take a rest, especially if the market takes a rest. So there are a few ideas that are worth considering. Thanks, Kenny, for joining us today. This was a great education, and we're definitely we only got to, where do we get to? 1987. So you're only 26 years old in the podcast world. So we're going to have to bring you back soon so you can continue your story.
Yeah, I didn't even get through the 90s, which was really an amazing time in the industry. And then the turn of the century and 9/11 and the role that played really in the development design of where the markets are today. But that's another story for another podcast. But call me, because I'm happy to finish it.
That's awesome. So thanks so much. So next week we will have Scott St. Clair back on the show. He is one of my fellow market smiths, and he's going to come back and we'll talk about the current market and a number of other things. So that's it for this week on Investing with IBD. I'm Arusha Paris, and thanks for listening.
And for this week's notes and charts, make sure to go to investors.com/podcast, where you'll find details for each episode in the podcast episode section. And make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.